Let's carry on with our question. And now we're dealing with one that has to, we've also in fact received this question from one of our on our Facebook page, where the learner said, please explain the loan adjustment. Right. Again, we start off by saying, make sure you know the question. Make sure you know the adjustment. What are they asking you to do? Okay, let's check this out. What do we have? You are told that loan from the bank is 1,725,500. So there's my loan figure, right? You are told that fixed monthly repayments, including interest, amounted to 31,600. You are also told that your capitalized interest amounted to 242,500 for the year, and for the year ended February 2018. All right? You are told that the interest for the next financial year is expected to be 162,000. Now, every bit of information that is given to you is important. Every bit of information, they're not giving it to you there just to fill the paper with amounts of and details. No, it's important why you are given that particular bit of information. You'll see how we're going to use it just now. They're also telling you that part of the loan will be repaid within the next financial year. Okay. Now, before we go on to this adjustment here, I want you to look at this here. And when you're dealing with the balance sheet, right, there are certain things that you have to know, right? It's something that's compulsory for you. When you're walking in tomorrow, before tomorrow, when you're walking in, you should know. Number one, in your balance sheet, separate your loan into two components. What are the two components of the loan? Your non-current liability and your short-term loan, right? So here you can see that you're separating your loan into two parts. Non-current, meaning repayable over a period greater than 12 months, and then the short-term loan, repayable within 12 months. So here you can see part of the loan will be repaid within the next financial year. Okay? So you can clearly see that's what we're talking about. Now, that's the one part. Obviously, of relevance to this particular question, we'll come back to it. The other one I want to bring your attention to is your fixed deposit. What must happen to your fixed deposit? Your fixed deposit has to be broken up as well into two components. One is your financial asset, right? And that is the amount that will mature over a period greater than 12 months, right? One part of it. And the second part will be that part of the fixed deposit that will mature within 12 months, within the next financial year. That has to become part of your cash and equivalents. Okay, so you've broken up your fixed deposit into two components. What are they? Greater than 12 months under my financial assets on the face of my balance sheet, and that part of my fixed deposit that's maturing within 12 months will appear under cash and cash equivalents, obviously. Why is that, people? Why do you think we do that? So that the reader of the financial statement can clearly see that within 12 months, there will be a fixed deposit maturing, which will be available in the form of cash, and that's why it forms part of my cash and cash equivalents. By the same token, why is my non-current liability separated into two components? The reader of the balance sheet can clearly discern that within 12 months, there will have to be a capital repayment of that amount, and therefore it appears as your short-term loan or the current portion of your loan, right? And the third item that you need to take cognizance of is your post-dated check. that we have issued. Okay? Now, obviously, dealing with it in the bank recon is a different component, but dealing with it in the financial statement, if there's a post-dated check that we have issued, right? And that information is given to you while you are drawing up the financial statements, what do you have to do? Number one, add to bank and add to creditors control. Now be careful. The add to creditors control is pretty straightforward. You just add it to creditors control and increase the creditors control amount. However, the add to bank means you need to find out the status of the bank account. What do I mean by that? Is my bank a favorable bank balance, a debit balance, or is my bank a credit balance? Is my bank in overdraft? And therefore, what will happen? So, if my bank is favorable and I'm adding to it, then it's going to increase the favorable bank balance. However, if my bank account is in overdraft, see here, let me illustrate. If your bank account has an overdraft of 10,000 Rand, right? And this particular check, this post-dated check, is valued at 2,000 Rand, watch, it's going to decrease my overdraft. In other words, what will happen? My overdraft will now be 8,000 Rand. So, coming back to the post-dated check that has been issued, what do we say? Add to bank and add to creditors control. Add to credit control is fine, but the add to bank, check the status of your bank account. Favorable, increase the favorable bank balance. If it's in overdraft, decrease your overdraft. Clearly you can see from the example that I've given you. Here's it here. Your overdraft was 10,000, is now 8,000 as a result of the post-dated check that has been issued. Clear? Okay, coming back to my loan. How do I go about putting this information down so that I can report on my loan? Very simple. Watch. Here's your loan account. Step number one, put in your opening balance. Your balance at the beginning of the year is let's just get that one. Your balance at the beginning of the year is 1,725,500. So step number one, opening balance, right? Step number two, what information do we have? We are told that my fixed monthly repayments, remember RTFQ, the monthly repayments amounted to 31,600. So what do? Take your 31,600 times 12, and that will give you a figure of 379,200. Watch. There's my bank figure. There's my 379,200. Once again, it was monthly repayments, so I multiplied it by 12 to get the annual repayment. So there we go, 379,200 is my annual repayment. Okay, step number three, what was I told? I was told that the capitalized interest amounted to 242,500. So therefore, watch, there's my 242,500. Now, the question arises, do you have to show all the details and the contra entries when you're doing this calculation? And the answer is no. I'm serious. You just have to draw your T account as a calculation so that you know what's the final amount and how it will be then presented in whatever is being required. Are you asked for the income statement or are you asked for the balance sheet? And you will see just now what I'm referring to. But obviously I've done it in detail so that you can see, you can comprehend what am I referring to. There's my opening balance, there's my bank figure, my annual repayments, there's my interest capitalized for the year. But if you're doing this and all that you do is doing a T account with figures, it's absolutely in order, as long as you understand what you are doing. Right, So I've got my interest. So all that I do now, I add the 1,725,500 plus my interest of 242,500 will give me a figure of 1,968,000. Subtract the 379,200. What am I doing, guys? I'm just balancing the account to give me a closing balance of 1,588,800. So that's my closing balance. Here goes, obviously balance brought down, carried down. So this is my amount of my loan at the end of this financial year. Right, now watch this here. Look at the way in which this is presented, right? 1,725,000 opening balance minus your capital repayments plus your interest. Now, let's go back and see what do they tell us. We are told that, we were told in the information that it is expected that your interest next year will be 162,000, right? Okay, so if that is the amount of your interest, 162,000, okay, look at your capital repayments. The figure that we had for our capital repayment amounted to 379,200. So let's take the 379,200 minus the interest figure which we want here. The interest is expected to be 162,000, 162,000. So obviously you left with a figure of 217,200. Let's write it down so we have it. Right? It's a 1,588,000. Let's just do this here. It's a 1,588,800. Okay? In terms of my calculation, right? And I know that the total cash repayment is the 379,200, but of that, what am I paying in interest? I'm going to pay back interest to the amount of 162,000. Okay? So clearly you can see if you take 379,200 minus the 162,000 will give you a figure of 217,200 minus 217,200, and this is what I want you to see now. Can you see there? This component that you are bringing in is your non-current liability that you're going to have to repay in the next financial year. So once again, it's your opening balance plus, minus your repayments plus the interest that's capitalized. Okay, but you are told that the 379,200 that you've paid this year, next year you expect to pay interest of 162,000. Let's do that again. So it's 379,200, which was your total repayment this year, minus the 162,000, which you expect the interest to be, and there you are left with the 217,200, which will be your capital repayment for the next financial year. Okay? So when you're reporting your non-current liability, that's how you report your non-current liability. But at the same token, remember now that under your current liabilities, you're going to have an item called short-term loan or current portion of loan, right? And that will be the 217,200. Your current portion of your loan, meaning that that is the amount, the capital amount that you expect to repay in the next financial year. Okay, so that was the loan story.